Hello and welcome to another episode on the Property and Lending podcast. Thank you, Fadi, for interrupting the welcome introduction. How are you, Fadi? How you going?
I'm good. How are you?
Good. And Mark, thanks for making time to be on this podcast. Busiest man in Sydney at the moment. So I had a request from a gentleman by the name of Mateo. I think he'll like the shout out, asking us to do an episode about equity and how equity works. What does it mean? How does the process work? How is it calculated? Are there exceptions to the rules? All that stuff. So that we decided, we will do an equity episode. So I guess just straight off the bat, Mark, if you want to tell us what's equity? What does equity mean? People throw out the word equity all the time, but what does it actually mean?
So the value between your property value today versus any loans you have against the property is equity that you can potentially access up to a certain limit, depending on a few things. But yeah, equity is the difference between the value of the property and the loan limit.
Okay, so how do we get equity? How does someone access their equity?
So, I mean, there's two ways, and it depends what you're planning on doing with it. So, for example, if you're trying to pull out equity for to renovate your property or to invest in shares or to go on a holiday, buy a car, whatever it is, if it's something like that, then essentially when you pull out equity, it's the banks refer to it as either a top up or a cash out. And essentially, you can go up to 80% of the property value minus your loan limit, whatever that difference is. And you can pull that out. Now, there are some lenders that are starting to allow you to pull out up to 85%, regardless of your profession. And then even more than that, if you're like if you fall in the medico sector package, so doctors, dentists, vets, physios, Kyrillos, there's a whole bunch of them, and they added a few, like sonographers and podiatrists are a popular one they just recently added as well. You can pull out up to 90% with select banks. They have to have those professions listed for you to do that. And accountants and lawyers also get it as well. So if you do fall into a certain profession, you can possibly pull out up to 90% without getting charged LMI, and you would receive that as cash. So they drop that into your transaction account for that bank. So whatever, if you're doing it with Bank X, you'll have a transaction account with Bank X that automatically pays off your loan, very likely, and they just chuck the cash there, and you're able to do with it whatever you want without them asking questions, and with you providing anything really. They really just ask why you're trying to pull out the equity. So they do ask for a reason at the time of the application, but that's it. After you get the cash, you do whatever you like. So that's the first way. In terms of the second way, and the most popular thing that we see is people pulling out equity to purchase another property. If you're doing that, there's two ways to do it. And there's one way that me and I believe Fadi both prefer, which is the same way, doing the cash out. So getting the cash, putting it into an account, and then using that as your deposit for the next one. Now, a lot of people will say, well, how about I don't want to pull out the money and start paying for it until I actually end up using it to purchase the second property. And it's a very easy solution. You're just going to pull out the equity in an interest-only variable loan product, which has an offset account, a 100% offset account. And you'll just leave the 50 grand or whatever you pulled out in the offset account, which means you're not getting charged principal because it's an interest-only account. And you're not going to get charged interest because you owe 50 grand, but there's 50 grand in the offset account. So there's no interest charged so long as the money stays in the offset, and there's no money charged for the principal as well. So that's how you would purchase your property with equity, unless you wanted to cross the two properties, but that's something we never like to do because you're kind of trapped.
Yeah, it's a good explanation. One thing, Fed, if you want to clarify, some people ask me this as well, and I think some people are not 100% sure around this. When you do get a cash out, it's not free money. Right, that gets added to your existing loan, or it becomes a new loan, or you are paying for that. They're not just giving you free money, correct?
Yeah, no, correct. And it's funny that you say that, but a shout out to Mateo. Look, we officially have a listener, so a confirmed listener, so that's good. But no, you're right. Because just being in the industry, like we've come across clients where they've been told by their bank, they've got access to 300 grand. And people were like, oh, so that's 300 grand the bank's giving me so I can use. I'm like, yeah, they're giving it to you, but you kind of owe it back to them at the same time. So for example, let's just say for argument's sake, you've got a house that's worth 500,000, 80% is 400 grand, like just the norm, 80% instead of the other professions up to 90, like Mark discussed previously. And you owe 200 grand. So you ideally can go up to cash out 200 grand of equity out of your property that now becomes a loan, like Mark was saying. And it depends on what you're using it for. If you're using it for home, non-structural renovations around the house, you're going to be using it straight away. You'll be paying principal and interest on that from day one. You also have the option of putting on interest only, but in some scenarios when you're owner occupied, you're looking to make those P&I repayments. But no, it's not free money. It's not money the bank's going to give you, or it's money that you have access to, correct? Because it's money that you've earned, or your property has gone up in the market, or you've paid your loan down. But any money that you have access to is money that you owe back to the bank, basically.
Yeah. So very important to clarify that. Yeah, people think it's easy money.
Yeah.
Sorry, Mark.
No, I had a customer that goes, no, I've got 300 grand to put a deposit. I'm like, no worries. Where's this from? He goes, oh, the bank's giving it to me because I've got equity in my property. So I had to explain that, that now is an outstanding debt. Yeah.
Sorry, Mark,
the interesting part, the interesting part with that as well. So keep in mind when Mark discussed purchasing a property with the equity being pulled out, for example, let's say I have an unoccupied property and I'm cashing out of my unoccupied property. With 99% of the lenders, there's only maybe 2 or 3 lenders that are allowed to put under unoccupied rates. That loan, even though it's on my owner-occupied property, is being given to me at an investment rate because I'm cashing it out for investment purposes. So customers need to keep in mind, if it's for non-structural renovations around the house, that's fine. That'll be P&I owner-occupied rates. But if you're taking cash out for investment, whether you're purchasing a property, investing in shares, managed funds, whatever it may be, that you're actually getting charged at investment rates. There's 2 or 3 lenders within their policy. As long as you fit between their policy, you can actually get owner-occupied rates on your owner-occupied property for investment purposes as well. But 99% of the lenders, just to keep in mind, when you're cashing out that equity, you're getting charged at investment rates, even if it's on your owner-occupied property.
Yeah. Mark?
I was just going to add 2 things. So, I mean, whenever this comes up, and we're simultaneously pulling out equity of someone's existing property while also putting through a pre-approval or a purchase through for them, you have to understand, like Fadi's saying, you do owe that money that you're taking from the bank. You have to pay that back to them. So that increases your loan balance, which means ultimately for the pre-approval or the purchase, it's going to lower your borrowing capacity because you're increasing your initial loan by the amount that you're pulling out. So very important to understand that. And there was one other thing, but I forgot. So when it comes up, I'll say it again.
So pretty much, Mark, it affects their servicing. You cashing out money, taking that equity is going to affect your servicing because that's now money that you're owing as well. So they have to take that into account.
Yeah.
And what you find with most customers is that they cash out the 20% plus stamp duty to purchase the investment property at 80% to avoid all those LMI fees. So that's like another big thing that a lot of customers are not aware of, is that you can actually cover the purchase amount where you're owing 80% on your investment property from day one, and you're still at 80% on your own occupied property, which is a great position to be in as well.
Yeah.
And you can probably elaborate on that, KM, in regards to investment and rental income coming back in. Yeah.
Yeah, for sure. Well, just before we get there, I was going to ask, and you said it yourself, servicing. I was going to ask, what are the criteria around being able to pull out your equity? Is it not just, I assume it's not just having the equity there. You still have to be able to pay it off because, again, it becomes a debt. So they go through the actual process when a customer comes to you and says, hey, I want to pull out my equity or cash out. From your end, is it the same as putting a new loan, like you're putting in the documents as per normal? You got to provide pay slips and all the rest?
Yep. So in most scenarios, like Mark touched on this as well, there's sometimes if it's not such a large amount, so if it's up to maybe the 50, 100K and with your current lender, they can do an assessment over the phone with you, and that's more of a top up. So Mark discussed that previously. It's like more of a top up loan where you're taking cash out for investment purchases as well. But if we're talking about anything over 100, 150, in my opinion, the banks are going to want a whole new application to be submitted for that portion.
Yeah. When Mark, you were saying they'll ask you why you want it, if it's renovation or not. Does your answer actually? does your response make a difference? Does it matter if you said renovation or if I said, holiday? Or does the bank actually care what your response is, or do they just want to see you can service it?
They do. At the end of the day, the bank still has a responsibility for the clients to make sure that they're also working in their best interest. So if you say I'm pulling out 200 grand for a car and it's at a 30-year loan term, in the bank's eyes, you need to get a car loan. You're going to pay an enormous amount of interest over 30 years as opposed to just having the normal 5, 7 years, whatever it is, for a consumer car. So if it's something like that, the bank will have more questions and they'll try to, like, you can still do it. There's no reason why you can't do it. You can still do it, but you can maybe set the loan term for 10 years, for example, or 7 years or whatever, while still getting the same interest rate, which is going to be lower from a car loan to whatever the home loan rate is that day, for example. So your answer does matter. But if you're talking about, like, if you're going to say renovation or investment in shares or something like that, it will raise more questions. If it's investment in shares, they might ask you for experience. They might ask you for your portfolio to see how you've gone, because they're not trying to put themselves at risk of not being able to recoup that money if you use it for investing and it goes wrong, for example. So it will raise more questions, but something like renovation is very safe. Because they don't ask, especially if it's like 100 grand or something, they're not going to ask for invoices or whatever when you come to do the renovations from the trades and stuff. And you'll be able to pull out and do whatever you like with it. So the reason does matter, yeah.
Yeah, okay. Is there a minimum that you typically have to, like, is there a minimum amount that you have to be pulling out, or as long as you can service it, they don't care?
Yeah, as long as that service is on the calculator, they're fine. To give you up to that 80 or 90%. The dollar value isn't important, but once it goes over like it depends on the lender, but once it goes over a certain amount with each lender, 100 or 200 grand, that's when they might ask to see more things. But even those, like Fadi and I have seen those rules relaxed a bit in the last few months with some of the big lenders, where they stopped sort of asking as many questions, even if you're pulling out more than 200 grand.
Yeah. Yeah, cool. The LVR, which you kind of alluded to, the 80 or 90%, you cannot access equity unless your LVR is at a certain percentage. Is that correct?
So ideally, like, for example, if you're taking equity out and you go up to 90% LMI, the only reasonable reason for the bank to allow you to do that is if you are purchasing another investment opportunity, where it's allowing you to earn more money out of it. But if you're going up to 90% because you want to buy a new car and paying LMI on top of that, or going up to 90% because you want to do a few renovations in the house, which is going to cost a little bit more than usual, then they kind of put up, because they don't want to charge you LMI again, because it's not in their best interest as well. And it's not in your best interest to pay another fee as well. But if it's for future investment opportunity and you're willing to pay the LMI, and it does make sense, they really don't have a problem with that. Ideally, when it comes down to the bank, they want to make sure that you can service it with flying colors, obviously, and you need to have a reason why you're taking that cash out.
Yeah. Okay.
Yeah.
So if someone wants to calculate their available equity, 80% of your property's current value, subtract what you owe, and that's essentially what available equity you have. You still have to service it and meet the criteria of the bank and whatnot, but that's how you would calculate it. Is that correct?
Absolutely. Yeah.
I was just going to say, just with that, a lot of people, when they come to do it, are going to do the property value minus the loan balance, not the loan limit, which a lot of the time are different. If you've paid on your statement, it will say what the loan limit is, which is what you owe, including anything sitting in the redraw facility. So if you've made extra repayments of 20 grand over the life of your loan, for example, your loan limit is going to be 20 grand higher than your loan balance. So you need to use that higher figure, the loan limit, not the loan balance.
Yeah, and obviously, if you had an offset account, you do not include whatever's in the offset. You don't subtract that as well.
No. The loan limit is everything you owe, not what you're getting charged interest on. It's everything that you owe eventually. Yeah, you need to pay back.
Yeah, cool. So, I mean, people sometimes will ask, well, what's the point of equity? Like, why would I pull it out? Why does the bank want to give it to you? I guess from our perspective as, building portfolios and investing, it's sometimes much quicker and easier to pull out cash, pull out equity, than having to save up another deposit, and obviously using that equity as a deposit for the next purchase. When you have two properties, for example, now both of them increasing in value, where you can then pull out equity again from one or two or both properties, and then continue to purchase and purchase without having to constantly build up your own deposits. So that's how we see it and why we would, continue to use equity. Obviously, you have to continue to service and make sure that you can afford it, and the banks won't give it to you if you can't. But from our perspective, that's the best. It's the best way to do it. You buy property goes up in value. You're reducing your loan as well by paying off debt. You've got this equity without having to save up another $100,000-$200,000. You can use that, buy another property, and whatever money you've got, you can put it into offset accounts or use for your own personal needs and wants and whatnot. So from our perspective, equity is amazing. I think the bank's perspective, correct me if I'm wrong, is if you weren't going to do that, if you weren't going to put out equity, you're probably going to sell the property to get that, profit, and then buy something else. And for them, they'd rather have you have more loans with them, right? Because
I was just about to say the bank wants you in more debt.
Correct.
The bank wants you for life, not 30 years. They want you for life. So
that's right. Yeah. So
the longer the loan is open for, the more interest they're eventually charging you. So it's the more profit that they receive from you. So that they're very happy to give you a cash out. There's never a time where they're just going to turn it down for no reason. They're very happy to always do that.
So KM, you're technically the bank's best friend. So you're like an agent for them.
In terms of the process, if I wanted to cash out really quickly, how long does that take? I come to see you guys, obviously at Power Loans, and say, hey, I want to pull out equity. What do you guys need from the client? How long does it take? What's the story there?
It's pretty much like a normal application, and with the time, it all comes down to which lender we go through. Each lender have their SLA days, pretty much how many days they take to pick up the loan. But it's just like a new application. So again, ID, pay slips if they're self-employed, 2 years financial. If it's under 2 years, we've got other options for that for low doc. But it's pretty much like a normal home loan application to put it through, because we pretty much have to say your current liabilities are this, your current assets are this, and are you going to be able to service with the new liability coming on top?
Yeah. So
it's actually, I was going to say the only difference between this and like a refinance or a purchase is that there's no other party. It's literally just you and the bank. So as soon as the bank gives you that formal approval, loan document signed, they'll give you the money. They don't need to wait for a formal settlement date and wait on someone else's schedule. So it doesn't take, like, for example, 6 weeks is how long, like, for example, a refinance may take, and the normal settlement period for a purchase, but it will happen in less time, definitely, than that, because there's no other party.
Yeah. So if I was coming to you and I wanted to pull out equity from my existing property, but the purpose was to be buying another property, would you be doing 2 separate applications? Is it one application together? How does it work on your end for that?
So you're doing the cash out as one application on your current property, and you're doing a pre-approval for the investment opportunity.
And is that happening concurrently?
Concurrently. So we would submit the cash out first, and right after, a couple of seconds after, submit the pre-approval as well. And on the application, we'd link both applications. So we'd say on the first one, pre-approval going through with this reference number, and vice versa.
Yeah.
And that's actually a good point. Sorry?
Yeah. No, go ahead.
You actually brought up a good point. So if we are going to tell the banks that we're doing a cash out for future investment opportunity, you'll find most banks saying, okay, this is pre-approved, but we're not releasing the funds to you until you show us a pre-approval for the new purchase. Whether that pre-approval is through the same bank or for a different bank, they need to see that conditional to release the funds. Where I understand where you're coming from as a buyer's agent, where you ask customers, or customers who are like, I'll just cash out the equity for future investment opportunity and put it there sitting there. But if you were told that most of the banks saying that you are going to buy an investment opportunity, they'll hold on to that money until they see the new purchase. They won't release it.
Yeah.
But I mean, it depends obviously on the amount, but with the released rules around cashing out in the last few months, there are some banks that will still pay out the cash out, even if it's for investment purposes before. And I always tell people, and Fadi's like, even when I started and we were talking to Fadi, just general stuff, he was always saying he would never, and I would never tell a client to purchase, like sign a contract with another property unless your funds that you need to complete the purchase are available. You don't want to risk the bank doing a reassessment and then not giving you the funds and then cooling off and subject to finance course finished, and now you're sort of stuck and you're going to lose the property and your deposit and you have no right to bring it back. So if you're going to cash out, get the money, have it in your account sitting there, interest only variable account in the offset. You're not going to pay for it. and you have peace of mind knowing that I can do whatever I want for this, and this contract that I'm about to sign is not going to fall through because I do have the funds.
Yeah.
You can't do it early enough, essentially.
It kind of makes your job harder as well, where you're going to try and negotiate the purchase of a property, but then we'd have to go back, reassess the pre-approval for the cash out, and then start the process of the new purchase.
Yeah.
And if it's two different banks, I think you already know from experience that's a bit of a nightmare. So
Yeah. So would the best way to go to take care of that process, get your cash out. Once that's cashed out, then apply for a pre-approval? Is that the best way to do it, to make sure all your ducks are in a line? And
I'd be, again, still submitting both applications at the same time, cash out and the pre-approval at the same time.
yeah.
It just, you would never do a cash out and a purchase at the same time, because then you're stuck with the purchase. But pre-approval, they'll just have a condition on there that they need a set of funds to complete the purchase before they give you formal approval, which is fine.
Yeah. Okay. So in summary, call Power Loans and they'll sort it out.
Yeah.
And cash out early.
With the power in their hands.
Before you even start looking, just cash out. You're not gonna get charged anything, and it's gonna work out better for you.
Yeah,
it's all in the logo.
I don't have anything else to add on equity. Do you guys have anything else?
No. I think we've pretty much covered most points, yeah.
Thank you, Matteo.
Oh, actually, there is one more thing. I always